This video will serve as an introduction to our next topic, topic 9, which deals with closing entries. First of all, let's take a look at your screen. We are looking at work that's done at the end of an accounting period. As you know, businesses vary as far as the length of their accounting period. It could be a month, could be 3 months, could be a year. It depends on what works best for that particular company. But at the end of whatever time period that is, there are certain steps that need to be taken. We've already covered some of those. But listed here are the 4 basic steps that an accountant needs to handle at the end of the accounting period. Number 1, at some point at the end of the accounting period, we need an evaluation of the inventory. And you did that in topic 7. We calculated and recorded the cost of goods sold. Some businesses use FIFO, first in, first out. Some use LIFO, last in, first out. Some use the average cost method. But at any rate, that needs to be done at the end of the accounting period. Second, this step we talked about in topic 8. We need to calculate and record depreciation of the major assets for the business. This is done at the end of the accounting period. And again, these are major assets. Things like a delivery truck, for example. We use examples of computer systems, those types of things. So those major assets wear out over time, and we need a way of calculating how much they lose in value. So that was topic 8. Incidentally, some major assets may increase in value. Real estate, for example, buildings and land may actually increase in value. We haven't talked about that. We may get to that later in the course, but for now we're talking about assets that decrease in value. The third step is then to take all of the balances in the ledger, the closing balances in all of the assets, the liabilities, all of those accounts, the revenue, the expenses, all of those balances end up in financial statements. And we looked at 2 different kinds, income sheets and balance sheets. And you did that recently at the end of topic 8. Now, the fourth and final step comes after we make the financial statements. We go back into the journal and ledger and we record the 3 closing entries. This is an important process that needs to be done to update the balance of the owner's equity account. The account called owner's equity is very often the most important one to the owner because he or she wants to know the value of the business. That's what is reflected in the owner's equity account. So we need to make sure that balance is updated, and we'll see how that works. In order to do that, we're going to look at a business that we had just recently. So I'll look at the tab at the bottom, and the journal is for the XYZ company, and all of these transactions have been journalized and posted. And you had this, as I said, just recently. We bought some computers, we bought some inventory, we had some sales, payroll entry was put in, cost of goods sold was calculated and journalized and posted, as was the depreciation. So that has been done already. Now we're ready for the next step. Actually, you already did the next step after these accounts or these entries were journalized and posted. The next step was going to the financial statements and entering the ending balances in these 2 statements. We had an income statement where we put the revenue accounts and the expense accounts, and the XYZ company for the month of February had a net income of $2,410. On the balance sheet, we put all the assets, we entered all the liabilities. These are all the ending balances of those accounts. The only glitch to the whole thing was owner's equity. And you had this note in your last problem in topic 8, that you find the owner's equity by subtracting the total liability account, total of all those liabilities. That total is subtracted from the total of all the assets, and that gives you the owner's equity. And then when you add up those two numbers, liabilities and owner's equity, it comes up to the same number as total assets. So the balance sheet does balance. So that's how that is figured on the on the balance sheet. You use the accounting equation. However, we're not completely finished yet because that number does not correspond to the balance shown in the owner's equity account in the ledger. That's what topic 9 is all about. We need to make this happen. We need to make this account accurate. And at this point, it is not yet. We do that by going back to the journal and entering 3 what we call closing entries. There are 3 different ones. One entry closes or makes a 0 balance in the sales account and moves that money to another account called income summary. The second closing entry closes the expense accounts and moves that money to the income summary. And the third closing entry actually closes that new income summary account, moves that money to the owner's equity account. Let's take a look at how that plays out. You see, on the end of the month, February 28th, we are putting into the journal a closing entry. If you see whoops, I don't want to get too far ahead of myself here. The description of this entry is this: end of accounting period entry to close revenue account. So, first closing entry closes the revenue account, which is sales, and you see it's debited, and you see the credit for this entry goes to an account called income summary, and that is the same amount of money. The $31,800 comes from the sales account. So we have a balance in sales of $31,800, and to post this, we will debit $31,800. And that's what we did in the journal just a second ago, as you saw. So what that does is make the balance, the ending balance in sales, 0. That means this account is closed. So the account number 401 goes back to the journal, and we've posted that. Then, as I said, the credit in this first closing entry is to an account called income summary by that same amount, $31,800. And that account is listed under the owner's equity in that section. So let's do this. Here's J15. And that is credited. This account is 302. So back in the journal, it's 302. You simply have to remember how this works, and we'll see how it all plays out after all 3 entries are in. So that's entry number 1. Second entry is an entry that closes the 3 expense accounts. So let's do the credits first. Let's go to the expense accounts. It says depreciation expense computers, $250. Where did we get that? Well, we got it from this account, depreciation expense computers. Let's put this in. Post that entry. And that was a credit back in the journal of $250. So when I do that, my balance is now 0. So I have closed that account. I've made it 0. And this is account 501. Back in the journal, 501. So let's do the credits first. Next one is sales expense, credit, $15,000. We go to that account, sales expense. And I credit, as the journal said, $15,000. And I use $15,000 because that's what is needed on the credit side to balance this account out to 0. This is 502. And one more. Cost of sales, cost of goods sold expense, $14,140. That's what's already in that account as a debit. And when I post that as the credit, as was shown in the journal, that now has a zero balance. So when I put the information into the journal, I simply look at what the balance is in the ledger and put it in accordingly. So this was 503, and that's been posted. Now, as you see, the debit part was to this new account, income summary, $29,390. I got that by adding those three credits because I know that every entry has to have a debit and a credit, at least one of each. And what's more important, the debits have to equal the credits. The credits add up to $29,390, so that's what I need in income summary. So let's go back to that. This is our new account income summary. We use it again from J15, and that was a debit, $29,390. And that leaves me with a balance, as you see, of $24.10, which might sound familiar at this point. But let's finish the posting. 302 goes back to the journal. And now I have posted that entire entry. Again, this entry closes these expense accounts. They had debit balances. By crediting their balances, they have zero balances. So the money, in effect, was taken out of those expenses, put into the income summary account. And the last entry that we need is to close, as this says down at the bottom, the end of accounting period entry to close the income summary account. We just opened it, now we're going to close it. Where do I get the $24.10? It comes from the income summary account. So to close it, I need the date and J15. I need a debit of $24.10. If I do that, that closes this account. It now has a zero balance. And again, account is 302. We go back, put 302, and look what gets credited, owner's equity. There has to be a debit, there has to be a credit. The credit in the third closing entry always goes to owner's equity by $24.10 because debits have to equal credits. So when I do that, back in owner's equity, whoops, with a credit of $24.10, lo and behold, the balance in owner's equity now is the same number as we had in the balance sheet. We used in the balance sheet this accounting equation to figure it out, but after we do the three closing entries, we close the revenue into income summary, then we close all the expenses into income summary, then we close the income summary into the owner's equity. So this shows us that at the end of January, the business was worth $62,125. At the end of February, it has a balance of $64,535, and that's what's shown on the balance sheet. But what's important here is that there is, in effect, a paper trail. There's a series of entries, these three entries in the journal, one of which closes the revenue account, one of which closes the expense accounts, and one of which closes the income summary account. You follow that through, do all the posting, and the credit goes to owner's equity. So that's the final step in the end of the accounting period work. So at this point, I'll ask you to go back to your course page. There may be some questions for you to answer.